Well, hey there, everybody. Welcome back to another episode of Disrupt Your Money. I am really excited for this episode. I think I say that every episode, and I apologize for that, but not really. But I really am excited for this episode because today we are talking about one of my favorite things that we do in my business, and it is your books. Your accounting system, the place where your numbers live, the thing that nobody ever wants to talk about because people hate talking about the numbers. It's not sexy. It just feels gross inside. And I get it. But I love talking about your books so much because having good, clean, organized books and staying on top of your books makes such a huge difference in your business. And when we think about disrupting our money and the goal of this podcast and this business and this community, which is to work towards and achieve economic equity, it's to build wealth for marginalized business owners and communities. When we think about that being the goal, how do we get there? It's not the super sexy stuff, although some of those tactics, work, like buying real estate or investing or all that. I mean, yeah, we got to do all that. That stuff's really important. But when it really comes down to it, we've got to start with the basics. And in order to get there, to achieve those goals, those basics, things like making sure we have a handle on our numbers are the really critical pieces. Because if we don't have those figured out, we're not going to get anywhere. In fact, I saw a really great example yesterday. This is such a tangent I'm going on. This is not in my notes, but I saw a really great example yesterday on Instagram. Mel Robbins did a thing where she showed, two cups. I wish I could show it for folks watching the video. But she had, two glasses. And she said, some people, the way their minds think is they go kind of, one glass here at the very beginning, one glass here at the end, and they just want to skip right ahead to the end. They're the big dreamers, the big thinkers, the big idea people. And then you have other people who, and then she put a bunch of glasses in between it. She said, you have other people who can picture every step they need to take, but it's really hard for them to envision the big end goal because they're very much more like the logistical, the operational, like focusing on the steps. She was talking about how in order to build a business or really do anything big, you need to kind of have think about it in both ways. Well, I think this is a great example of that small steps piece where, when we think about achieving economic equity, we think about building incredible wealth, we think about raising up marginalized communities. I think a lot of us have the dream piece handled. A lot of us are doing the jump from the one glass to the other that are really far away. We've got that dream. We've got that vision figured out. It's all those in-between pieces that, is a little harder to understand exactly what those should look like and what those are. And also a lot of the times it just feels really demotivating because it feels like there's so many cups that we have to step on to get to the big one, right? But your books are kind of like one of those cups at the very, very beginning. It's one of those things. And by the way, I would also equate tracking the money in your personal life exactly the same way. It's one of those things that we just have to do, because if we don't do that step, then we don't have the information we need to be able to pave the way to that last cup at the end, that big vision, that big dream. So stick with me here. I know I just really tried to sell you a big dream about books, but I truly mean it, that this is one of the most critical things you can do in your business, is making sure that you are doing a really good job of tracking your money. Now, this episode is not going to be your run-of-the-mill podcast episode. Maybe you've already gotten that sense. We are not going to talk about, 7 steps to set up your bookkeeping or anything like that. That's not what we're doing here. If you need that tactical approach, that guidance, we have that. And you can get that by going to I just forgot the website. I got so excited about books, I forgot the website. You can get that by going to equitablemoneyproject.com/wave, WAVE. It's It's called Wave because that's the accounting system we like, but anybody can benefit from getting access to our free Biz Money library. Inside of our free Biz Money library, there's lots of resources on how to set up your books, including general resources for everybody on how to choose an accounting system, and guides that you can use no matter the accounting system you use. And then there's also a Wave Apps 101 training if, like us, you are a fan of Wave Apps or you just want to use it because we're telling you to. You can get all of that by going to our Biz Money library, which again is completely free for you to access. And the website is equitablemoneyproject.com/wave. So that exists in the world, but that is not what we're doing in this podcast episode today. Today, we are really going to be talking about why this stuff matters so much, because I want you to understand, like in your core, that this is so much more than just a checklist step that you have to do. So let's talk about why bookkeeping matters, and by the way, I'm using a lot of terms. So actually, let's take a step back and break this down. When I talk about your books, I'm talking about, think back to the olden days when we didn't have computers. Businesses, I wish I had an example. Businesses literally had like a book, like a ledger that they would track all of the money coming in and the money going out. So that's where the term books came from. Bookkeeping is the management or the maintenance of those books, making sure that your transactions are in there, that they're categorized, that everything is clean and organized. Your accounting system is a tool, usually a piece of software, that you use to track your numbers, to track your books. So your books live inside of your accounting system now, whereas in the past, they would live inside a very, very large brown leather ledger, most likely. So that's what I'm talking about when I use those terms. So why does bookkeeping matter? Well, you cannot grow what you do not know. Let me say that again. You cannot grow what you do not know. If you do not know the numbers in your business, you cannot grow your business. And if you cannot grow your business, you cannot achieve the wealth that you want to achieve for your community. You cannot achieve the equity that you want to achieve for our society. And we cannot achieve that grand vision that I know we all share. So we have to understand the numbers in our business. If you want to reach those big dreams, that big vision, we have all got to put on our big person pants or skirt or dress or whatever the heck you like to wear and be the CEOs of our own business. The CEO of Amazon or GE or, pick another big business. The government isn't going to say, I think we can just wing it. Who needs to look at the numbers? I'm sure it's fine. Money's coming in, money's going out. It'll all be grand. We'll do that later. I'll do it when I have more time. I'll do it when I make more money. I'll do it when I can hire somebody to do it. Imagine if those big companies or organizations were taking that approach, they would never be in the place that they're in because they never would have gotten there because it doesn't work. It might work for a little bit. You might be okay right now. You might have enough cash in the bank right now. You might have enough money coming in right now to pay your bills. But I promise you it's not going to last forever. And I can tell you that when you look at these 7- and 8-figure revenue business owners, I know at least a handful of them personally have had cash flow problems because they did not set up good systems. They did not have organized books. They did not stay on top of their numbers. So yeah, they might be taking in a lot of money, but that doesn't fix everything. It doesn't make everything okay for them. They ran into problems because they didn't have their financial foundations in place. So we've got to stop saying we'll do it when and take control of the situation now before it is too late, because there are businesses that go out of business because they run out of cash. There are businesses that go out of business because their sales are dwindling and they don't realize it. They're not paying attention to it and they don't pivot quickly enough. So it's so critical that we know our numbers and we stay on top of this stuff. Now, what's really important to understand about your books, when I say like know your numbers, know your bookkeeping, do your bookkeeping, whatever, what I'm talking about, like for somebody who needs this broken down, I'm a visual learner. So I'm like, you got to break this down for me and like show it to me. What I'm talking about is when you log into that accounting system, QuickBooks or Wave Apps or whatever it is that you use, and you pull a report, and there are multiple kinds of reports inside of the accounting system, but most people are going to pull that profit and loss statement, or an income statement as it's often called. And that's going to show you all the money that came in and all the money that came out and where it went. Where did it come from, and where did anybody hear that song in their head? I did. I won't sing for you because that'll be traumatizing. But that's what a P&L, or profit and loss statement, is going to show you, is where the money has come from and where the money has gone over a period of time. You can pull it for a day, a month, a year, whatever you want. But here's what's important about that report and other reports. Number one, it shows you what's happened in the past so that you can understand where you've been. You can understand what has happened in the business up until this point. That gives you important critical data that you can use to make better decisions in the future. Number two, it understands where you are, helps you understand where you are right now. It shows you your profits. It shows you your cash flow. It shows you if you have cash flow issues. It shows you where your sales and your money is coming from. It shows you what you're spending money on. It tells you what is going on right now in this moment. What is your current financial position? And then number three, it allows you to plan for the future, because you can use that critical data from the past and the knowledge of your situation today to figure out how to move the business forward. Okay, so that's why this stuff is so important. Now, I also want to make it clear, because this comes up a lot when I start talking about books. People say, well, I just need to worry about it for my taxes. My accountant's going to want the information, so I just got to get it in order for them. And in fact, our bookkeeping cleanup package that we offer at the end of the year is popular because there are people out there who don't look at their books all year and then are like, shit, my accountant's going to need my numbers. I got to get this in order. I live for the day when nobody wants that package because everybody's books are clean. The least important purpose for your books is for taxes. And that's still a pretty important purpose, to be clear, but that is the least important purpose. This is not just about preparing for taxes. If you only look at your numbers once a year, you are doing a disservice to your business. You're doing a disservice to your community, to your family, and to those greater goals that we talked about. You've got to understand what's happening in the business on a regular day-to-day basis. And I know how uncomfortable it feels. I know how icky it can feel sometimes. I know that feeling of dread in your stomach when you look at the numbers and they're not what you want them to be. And you start telling yourself a story about what that means, about who you are as a person, about who you are as a business owner, about your future. I get that 100%. But we cannot grow what we don't know. We cannot fix what we don't know. If you continue to ignore the numbers in your business, you will never, ever, ever be able to grow a long-lasting, financially successful business. I can promise you that. There are very few things that are certain in this life other than death and taxes, and that's number three, is that if you do not know your numbers, you will not grow a long-lasting, financially successful business. You may have it for a bit. It may make some money for a bit, but it will eventually implode because you cannot run a business without knowing your numbers. Now, I also get asked a lot by people, well, can I outsource it? Can somebody else just deal with this? In fact, we did a survey. We just offered a lifetime membership into our membership, and we did a survey to folks who didn't buy. And like 5 or 6 people said, I didn't want to join the membership because I just want you to do everything for me. We make you do a little bit yourself in the membership. And I get that. I get that feeling of like, can somebody else just handle it? Don't want to do it. Have you ever heard somebody say, this gets talked about a lot, especially when you're newer in your business, that you should do every job at least once before you outsource it? And that's a really important piece of advice for a business owner, because what it is saying is you need to understand the nuances, the details of this work before you can find the right person to actually do it. And I think bookkeeping is exactly the same. In this case, it's critical that you have spent some time with your numbers so that you understand what's going on, because the minute you outsource it, it becomes a lot easier for you to completely walk away from it and ignore the updates, the reports that your bookkeeper sends you. Now, I'm not against hiring a bookkeeper. We provide that service for folks. I think that's good if you're at a place where you can afford that in your business and it makes sense for you. But I think it's really important that you understand the inner workings of that work before you outsource that, so that when your bookkeeper does give you those reports, you know how to read them. when they give you those reports, you understand how important they are because you've been in the numbers. So you understand what that data is telling you and how critical that data is to moving your business forward. So can you outsource it? Yes, absolutely. But do not pull yourself out of that important work because it's really critical that you have that information. Okay, so maybe you've heard all this and you're like, cool, you've sold me. I'm going to go do this. I'm motivated for like a hot second. I know I'm going to lose that because we're talking about bookkeeping. It's the motivation's not going to last that long. But you're thinking, all right, I'm going to do it. What do I actually do? Where do I start? Well, number one, you need to choose an accounting system. Now, I talk a lot about the accounting systems that we love and the ones we hate on this podcast and elsewhere. But as I've already mentioned, we're huge fans of Wave Apps, WAVEAPPS.com. There's no affiliate link because it's free. This is a free product. There are some paid features. You don't necessarily need to pay for those. Payroll is paid. If you invoice, there will be a transaction fee, just like there will be on any other invoicing tool. But otherwise, you're not paying for Wave Apps. So as an accounting system, it is free. That's one of the reasons why I like it. Another reason why I really love it is because it's easy to set up and easy to use. I am not a fan of QuickBooks. I am not a fan of Xero for most people because I think they are complicated for people to use. I think they have too many features and they were built for accountants' minds, not for regular business owners' minds. So I don't support most people using those tools unless there's a really good reason to do so. I like Wave Apps because it's free, easy to set up, easy to use. For most people, it is the most manageable accounting system. It is the most user-friendly accounting system, and it is the one that will keep them doing their books longer, staying in that work longer, and that's why I love it. Now, if you're already on QuickBooks, if you're already on Xero, if you're already on something else, do I think you need to immediately drop everything and move over? No. If it's working for you and you're actually staying on top of your books, stay there. Stick with what's working. Don't rock the boat if you don't need to. But if it's not working, now maybe is a good time to switch. Now, I'm also often asked, not that I want to make this a podcast on different accounting systems, but I'm also often asked about FreshBooks. FreshBooks, my recollection from a few years ago was it was basically an invoicing tool. They have worked to build out an accounting system tool inside of FreshBooks. I still don't love it. The reporting to me is really clunky. It's very limited. I just don't see the purpose of it. And you have to pay for FreshBooks. So I don't love that. So Wave Apps is my favorite, waveapps.com. Check it out. And again, if you go to equitablemoneyproject.com/wave, we have a free Wave Apps 101 training. It's an hour. It'll walk you through all the steps you need to get set up on Wave Apps. So that's step number one, is figure out your accounting system. Okay, step number two is to actually set it up. And I'm not going to go again through all the different steps of setting it up. We've got a training on that, but this can take about 1 to 2 hours depending on how much you've got going on, depending on if you're coming over from another accounting system or not. So plan that, pick a weekend, pick a morning, whatever, set aside some time, get that done. Once that's done and everything's set up really nicely, it shouldn't take you that much time ongoing to manage and maintain the system. But that leads me to step number 3 of what you do need to do, which is to set up a process for regular check-ins. So I like to recommend that our community do at least twice a month. We call them money meetings. But if you're newer to this work, to the bookkeeping, to stay on top of your numbers, I would do weekly. I personally do weekly in my business, and I have for years. But I would do weekly money meetings, money check-ins, money dates, whatever you want to call them. And that's where you're going to do 3 things. Number 1, if you don't have a bookkeeper, you're going to categorize your transactions inside of your accounting system. Number 2, you're going to reconcile your bank and credit card statements. I'm not going to go into exactly what all that means. We talk about that in the training. We've got videos on that. And number 3, you're going to review your reports, your P&L, your profit and loss report, your balance sheet, which shows how much cash you have, how many liabilities you have, all that stuff. You're going to look at all those reports, and you're going to do some of that important data analysis that we talked about before, understanding what's happened in the past, where you've been, understanding where you're at right now, and understanding how to move forward. That happens when you look at those reports. And again, I'm not going to talk about that right now. We've got trainings and resources on that inside of the Biz Money Library. So those are the steps. If you are just starting out with this, choose your accounting system, get it set up a process to regularly check in. Let me just tell you those 3 steps, and then continuing the work of doing those regular check-ins is going to be one of the biggest game changers in your business. I can promise you that. All right, so we're going to switch over to one of my favorite segments, which is money news that you can actually use, because there is a lot of news out there in the world these days, and most of it is questionable at best. Now, I got to take water for this because, this is a big topic. All right, so there has been something making the rounds on the social these days about Joe Biden, President Joe Biden, who has recently announced some changes to the fees with mortgage loans. And the general tone, the general consensus, and actually this was an actual headline, is Joe Biden is screwing over people with good credit so that Black people can buy houses. That was an actual headline I saw, which terrifies me to my core about the future of journalism. But putting that aside, here is what this whole thing is about. So, and I'm going to kind of give you the high level, and then I'm going to get into the facts and some myths as well. President Biden made this announcement that the fees on mortgage loans were going to be changing, and that the adjustments to these fees were going to make it easier, in theory, for people with lower credit to buy homes, but that might come at a cost to people with higher credit scores. Okay, so it's a quick refresher. Your credit score is supposed to be an indication of how credit worthy you are. We're going to do a whole podcast on credit scores because I think credit scores are one of the most inequitable things in our society and need to be destroyed immediately. But putting that aside, that is what your credit score is, and it is a fact of life right now. We live with them. Every big financial decision we make, mortgage, car, jobs even sometimes, are based off of our credit score. So they exist, they are what they are. The problem with this announcement, the problem with what happened, was it blew up into a twisting of facts. And unfortunately, certain news, if you're watching the video, you saw I just made air quotes, certain news channels, Fox, have taken this and run with it and completely twisted it. And frankly, I think what they're doing is actually really dangerous, because they are basically now flat out lying. And that's not surprising to anyone who's been following them for a long time. But let me tell you about some of the actual headlines I saw when I Googled this topic. Here are some of the actual headlines from what are supposedly reputable news sources, newspapers, TV channels. These are headlines. Biden's mortgage equity will screw up the home buying market. A penalty for good credit scores, President Biden must go. Biden is making you subsidize mortgages for deadbeats. Those are all headlines I saw. And let me just tell you, all three of those are false, completely and utterly false. And those are all being presented to the public as journalism, as news reports. People are reading this and they are believing this stuff and not recognizing it for what it is, which is propaganda. And it is incredibly politically infused. So I also found it shocking that when I Googled this, there was not a lot. In fact, I had a really hard time finding any neutral reporting on the matter, or even anything that was favorable to Biden. And I want to be clear, this isn't because there isn't anything favorable about this. It's because that stuff was so buried by all of this negative misinformation that has just completely infiltrated the web over the last few days, that it is impossible for a well-meaning, well-intended citizen who wants to understand this issue better to Google and find reputable information. So I just want to throw that out there. That's what's really scary about this topic. It's not that this topic is even that big of a topic. Like, let's be clear, of all the things we could be talking about, school shootings, racism, police brutality, there's so many things. There's so many bigger topics. But what's so wild about this one is how, for such a relatively benign topic, as you'll see in a second, it has been completely abused and misused and used to further infiltrate people's minds. And it's very, very scary. So let's dig into the facts. First of all, this decision only affects mortgages that are backed by Freddie Mac and Fannie Mae. If you're not familiar with what that is, they are not people. They are organizations, or government-backed organizations that essentially buy loans from lenders as a way of insuring them. So when you go get a home mortgage loan, and you get a loan that is ultimately backed by Freddie Mac or Fannie Mae, usually your rates are lower. It's a little bit easier to get because the lender knows, the bank knows that they've got that government-backed insurance that's going to cover in case there are any issues. So they're good. They feel comfortable making that loan to you. Now, the plan that President Biden released is designed, the intention was to make home ownership more affordable for more people. And that's why they focused on credit scores, because they recognized that people with lower credit scores have a harder time. It's more expensive for them to buy homes. And the reality is that people with lower credit scores don't always have lower credit scores because they're just deadbeats, as that article referred to. But oftentimes, many times, have lower credit scores because they have medical debt, which is a huge problem in our country. And we'll probably do a whole episode on that too. So that's what this was supposed to do. Now, what are the rates that we're actually talking about here? Because everybody keeps saying, oh, the rates are going to go up. The rates are going up. The rates that we're talking about in this change are not your interest rates. We're talking about what's called the loan level price adjustment, or the LLPA. And it's actually not it is a rate, but it's really a fee. It's a fee that gets imposed on the mortgage when you take it out. This fee, the LLPA, began in 2008 when the housing crisis was happening as a way to offset the risk for lenders during all of that chaos. This is not, again, not your home's interest rate. This is a fee that gets tacked on to your loan to help offset the risk for the lenders. The LLPA is calculated as a percentage of your loan value, and the rate that is used adjusts based on your down payment, based on the percentage of your monthly income that's going towards your housing payment, and your credit score. Okay. So here are some of the myths that are being thrown out there about this. One of the biggest ones is that people with lower credit scores are gonna pay fewer fees than people with higher credit scores, and that is just completely false. Even with the adjustment in rates, the rates for people with lower credit scores are still much, much higher than the rates for people with higher credit scores. Okay, so the rates themselves, yes, the rates may have shifted, but someone with a lower credit score is still absolutely going to pay a higher rate for their loan than somebody with a higher credit score. The second thing that's been talked about quite a bit is that if your score is high, if you have a high credit score, then this fee is going to go up for you. And the answer to that is maybe. For most people, probably not. There might be a small bucket of folks to where it does, but for most people, probably not. And here's why. So with the higher credit scores, they have now, one of the changes was they've introduced pricing tiers, or rate tiers, I think is maybe a better way to say it. So now there's different rates for different tiers based on your credit score and your down payment. So for example, if you previously had a 780 or above credit score and you were putting 25% down, your rate would have been 0.25%. Now it's actually going to be zero. Your rate's actually gone down. And that's what we're seeing for most people. Same thing if you had a credit score 780 or above and you're putting 20% or more down, your rate is actually going down, not up. There is a small group of potential buyers for which your rate might go up slightly, but it's still going to be significantly lower than those lower credit score folks, and it's not going to be that much of a bump. So this idea that Biden is raising these fees on the good, air quotes again, on the good, good people with high credit scores, so that lower score deadbeats can buy houses, just isn't true. Now, I want to be clear. I'm not necessarily defending this policy change. I don't know if I agree with this or not. I'll be honest, this is pretty in the details for me. And while I kind of have some opinions on both sides of it, I was an econ major in college, but I'm not an economist. I'm not sitting on the president's economic development team doing the analysis behind all of this to figure out if this is the best policy plan. I just don't know. But I'm certainly not defending it and saying that this is a great thing. What I am saying is we have to make sure we understand what we're critiquing. It's okay to critique it, but let's make sure we're getting the facts straight. And what's happening right now is we're not even being fed the facts. We're being fed these bylines that people want to put in our faces so that we will vote the way they want us to vote. And that is the scary thing. The other myth that comes up a bit is that, and I said this before, but I just want to clarify this, is that interest rates are changing or are going to be higher for higher qualified borrowers, and that is just completely false. This does not affect your interest rates at all. This has nothing to do with interest rates. It has to do with that LLPA, that loan level price adjustment fee I talked about, nothing to do with your interest rates, okay? So there's just lots of disinformation out there. Now, a couple of thoughts. I mentioned that I don't necessarily support this policy, but I don't really know where I stand. Couple of thoughts on this. Number one, I think this policy doesn't do enough to help with affordability in the housing market. I don't think it's really going to make that big of a difference. That said, having been in politics, I understand that there is always a balance between the sort of radical shifting of the way things are, which is usually really hard to make happen right away or in one fell swoop, and the desire to make small incremental changes over time that may on their face seem like they're not that big of a deal or not that impactful, but add it all up together can actually change the story. And so maybe that's what this is. Maybe his economic team looked at it and said, this is a step we need to take because it's going to get us in the right direction. And if that's the case, then maybe I do support it. I just don't know. The other thing I also want to mention is this is a fee that was added in 2008 because of the housing crisis. It was added to help offset the risk to lenders. We're not in a housing crisis anymore. It may feel like it for some people, but we're not. People have more equity in their homes now, even though interest rates are higher. We're not anywhere close to the situation that we were in 2008. So my question would be, why are we charging this fee at all? It may just be that it was already built into the budget and getting rid of it means they'd have to come up with the money somewhere else. Okay, and what do you do about that? I don't know, but I think these are all things to be considered in a constructive way when having a conversation about this. What should not be happening is people should not be going all over TikTok and Twitter and these news channels and throwing this out there as if Biden is charging good borrowers more money so that deadbeats can get houses. That is not the story here. So as you're looking at all this stuff, as you're on social, trying to follow all these breaking news stories, make sure you get the facts straight. All right, we are going to wrap this up with a listener question. Let's see what we've got here. So, this is a great question. So listener says, I missed the deadline to get my taxes filed on time, so I had to file an extension. Is this a bad thing? I'm worried about being penalized or having a red flag on my record. So thank you so much for this question, first of all. And you can always submit questions to us by going to disruptyourmoney.com. We would love to hear from you. We'd love to answer your questions on the air. Let's talk about extensions. So extensions are not a bad thing. That's the spoiler alert right there. Not a bad thing at all. Extensions are actually a really good thing because they give you more time and your accountant more time to make sure you do a good job preparing your tax returns. The number one thing I hate the most about the tax piece of our business is the stress so many people feel to get their returns filed by April 18th or it was April 18th this year, April 15th normally. And I get it because that's what society has constantly taught us we have to do. And there's always that anxiety about, well, how much do I owe? And am I going to get a refund? And I want my money. And I totally get it. But there's so much stress put on this one date that oftentimes what happens is we are rushing. We are trying to get everything done so that we can meet that date. And it is very hard to do a really good job within that short amount of time. We work really hard at it and I think we do it, but it's very hard and it's very stressful. So an extension is not at all a bad thing. An extension is a great opportunity to say, we need a little more time to make sure we get this right. Trust me, the IRS wants you to get it right. Now, here's the important thing to understand. An extension of time to file is not an extension of time to pay. And this is actually the one thing that I don't love about the IRS's system with this. I get why they do it, because if they gave you an extension of time to pay, everybody would take the extension of time to pay. I get that. But I wish there was a better system here because the reality is a lot of taxpayers don't know what they owe when they file that extension. They may be waiting on information from other entities and they just don't have a good sense for what their final picture is going to look like. And those taxpayers often end up in a really tough spot because they have no idea. Okay. But if that's not you, if you have a general sense of what you're going to owe or that you are going to owe, and you do file your return, still make a payment if you can, because at least you're putting something towards your potential tax liability. And again, there's no extension of time to pay, only to file. So if you file that extension to file, you still have to make a payment if you think you're going to owe money. And if you don't make a payment, or you don't make enough of a payment, you will likely owe interest and penalties when you finally file that tax return. So it is important to still work as quickly as you can to get the information in, or if you work with an accountant, to get it to them so that they can get it in. But it's also not something to stress about. I have had years where I have filed an extension and waited till October to do my return because I just needed that extra time to gather all of my information. And then I've had years where my return's done in February. It just depends on what's going on that year, what information I have and I'm waiting on. And there's absolutely nothing wrong with it. And no, there will be no red flag on your record. It's not a bad thing. The IRS offers it as an option because they want you to take advantage of it if it means your return gets to them more accurately. Okay. All right, friends, I am going to leave it there. So for more information about any of the stuff we talked about today, head to our website, disruptyourmoney.com. And remember, you can get access to our free Wave Apps 101 training and our entire free Biz Money library of resources by going to equitablemoneyproject.com/wave. And as a final reminder, if you love the work we're doing, please subscribe to the podcast and leave us a review. We would be so grateful. Until next time, friends, I hope you are disrupting your money in many, many ways. See you then. Thanks for listening to Disrupt Your Money. If you have a money question you'd like answered in a future episode, go to disruptyourmoney.com. To support the podcast, please rate and review it wherever you get your podcasts. And if you want access to all of my free templates, checklists, resources, and guides, click the link for the Biz Money Library in the show notes.